Everybody, Sean Carney, talking today about the industry's dirty little secret in annuities. By now, you've probably seen the Fisher Investments commercials where Ken Fisher's on there saying he'd rather die than buy an annuity. And oftentimes, if you go to financial advisor blogs and really just Google annuity, you'll see message board after message board of people just slamming annuities. And so I'm going to peel back the curtain for you a little bit and tell you why that is in the industry, and then kind of show you why there could be some value in buying one, and then ultimately what to do if you bought one and you're scared because you made a bad decision at this point and you're looking to get out. What are some things that you can do? So some of the reason that the industry hates annuities is because they're extremely, extremely expensive. There's a lot of hidden fees. They're extremely complex because annuities are an insurance contract. You are, essentially entering into an agreement with the insurance company that says, for a payment of some sort in the future, I'm going to give you a lot in fees. And they're smart, right? Smarter than probably the person buying them. And they kind of hide some things in there. So some of those things that you need to look out for. There's something called the mortality expense, or M&E expense. And that is a fee that you pay in case you die. Right? So they know that if they hold on to your money and you die at a certain point, that they need to make sure that they make a profit for themselves. And so they charge you an ongoing fee. And so if you think about this mortality expense, which usually ranges somewhere between 0.8 and 1.2, I've seen as high as 2%. That as your money, if it's growing, you're actually paying more as you get closer to death, right? As you get older. And so it's a nasty fee that's buried in there that no one really understands what they're paying for when they get that. Additionally, some of the fees in the investments inside of the annuity are extremely expensive because it's buried in contractual language. So a lot of times the mutual funds or investments that you're paying are anywhere from 0.8 to 2% again, right? Extremely high cost, all wrapped into it. And so there's also riders that can be added on, like if you want to have access to the money before you die, like early death benefit. If you want it to be inflation protected, more fees, right? 1% keeps adding up in terms of fees. And so you get a lot of these kind of fees hidden in there. Also, there's something called a surrender charge, right? So this is a fee that if you don't have the money invested for a certain time period, usually around 7 years, I've seen them as high as 25 years, that if you request your money back, then you're going to pay a fee, right? So the insurance company is smart. They know if they take your money and they invest it for 7 years, historically, they're probably going to make money. And so they say, if you want your money back before 7 years, I'm going to charge you a fee because I might not have made my profit that I need. And so you get the M&E fee, you get the high internal expense fee, you get the surrender charge fee, you get the riders for some of the benefits. And all of a sudden, your investments inside that annuity have to perform amazingly in order to recoup what you're paying in fees. And oftentimes, there's actually a cap on your investment. So the annuity will say, we're guaranteeing that you're not going to lose any money. Right? And so in order to guarantee that, we're also going to cap how much you make in a certain year. So they'll tell you that you're invested in the S&P 500, for example. If the S&P 500 makes 15% that year, there may be a cap on your portfolio of, say, 7%. So the insurance company is going to keep the 8% difference. So they're going to cap your return and keep the profit because they know that there's going to be down years, and the years are down, they're the ones that are going to be eating the loss. And so that's kind of where the trade-off is. And so that's why annuities get such a bad name, because they take your money, they lock it up from you, right? And if you want it back, they charge you a fee. And if you want access to it, they can take loans out and they'll make a fee. And there's M&E fees and high expense fees and surrender charges, and all these fees add up, and it's really hard to make money off of them. And in addition to that, if you want a payment from it, oftentimes they won't encourage you to get the inflation protection. So you'll get call it $1,000 a month payment, and that $1,000 a month today is not worth $1,000 20 years from now when you're still receiving that payment. And so they work on commission, right? So there's also commissions built into there. And so as soon as you sign that paper, the broker, the advisor, the salesman's getting paid immediately. And so their only incentives to sell, sell, sell. And so that's kind of the dirty secret behind annuities. So is there ever a reason to have one? Yeah, there could be, right? So annuities are one of the few vehicles in the world that can grow tax deferred or tax delayed. So you can actually max out your 401k, max out traditional IRAs, and still be looking to kind of defer taxes. Well, an annuity may be the only other option. So you may be willing to pay those high fees in order to get some of the tax advantages to it. There's estate planning needs. Once you pass away, that money goes passed outside of the state, outside of probate, and can avoid estate taxes, things like that. So it can be a benefit there. Also, for people that are like, I know there's a ton of fees in there. I fully understand that, but I don't want to lose a nickel of my money. Well, there's not a whole lot of things out there that you can actually earn a return and not lose anything on it. Just realize your return is going to be capped, and it's going to be pretty low after fees and all that. But that may be a reason to consider an annuity. When you're looking for an annuity, or if you've been sold one of these and this video is like, oh my gosh, I cannot believe I'm paying that much in fees. This is ridiculous. And you're looking to get out of it. Some things to consider. We've got a great relationship with a product manager out there that has a annuity that does not charge any commission. There's no surrender charge, no surrender fee. There's no M&E fee, right? It kind of gets rid of all those things, so it truly acts like an investment vehicle. Now, there's also no floor on it, right? So you can lose money in it. There's still risk available. And if you do want a protection there's a little bit higher of a fee, right? But in general, you're going to save thousands of dollars on fees by doing what we call a 1035 exchange, moving from one annuity to the other. And so if you think you're caught up in one of those, want analysis of your annuity, we'd be happy to take a look at it and find out if it makes sense to move it into a product where there's no surrender charges, no M&E, low investment costs, all of the good things, and all the ways that people should be investing other people's money, because that's how we want our own money invested. So if you want us to take a look, please reach out to us, and we'll find out if we can save you thousands of dollars. Some things to consider: the 1035 exchange and kind of doing this process may not be in your benefit if you're in the surrender period still. So if you're gonna have those surrender charges, the 1035 will not get rid of your surrender charges. And so, probably not going to be the best thing for you, but we'll be happy to take a look and do the analysis, find out if we can save you tens of thousands of dollars, put more money in your return rather than in fees.